Hey, listen, you're driving down the road and all of a sudden a bomb comes right on your lap. You got 10 seconds to live. And what is your first thought gonna be? Does my family have enough life insurance to create generational wealth? And if you have the right kind of life insurance, it'll create a money bomb that'll create that generational wealth. And we'll talk about the 3 types of life insurances in a couple minutes. Okay, so today we're going to talk about 3 different types of life insurance: term insurance, whole life, and universal insurance. And what life insurance is, whether it's today or in the future, it's a guaranteed number based on your future wealth. God forbid if you were to pass away, so your family can continue on and create that generational wealth. So the question is, why is it important to understand the different kind of life insurances? And that really goes back down to who you are. What are your goals and objectives? Where are you at, let's say, in the life cycle of your business? For example, if you're a newlywed, you're just getting married and you have a baby on the way, term insurance could be a good idea. However, if you're an entrepreneur that's really looking to get multiple uses of your own money, create your own bank and give yourself a tax-free form of income of retirement, that's where whole life comes into play. Lastly, if you're a super duper entrepreneur and you want to take advantage of premium finance strategies by having the bank pay the premium on your whole life policy, but throw in a IUL wrapper, an index universal life wrapper, so you can take advantage of the stock market, well, that's another story that we could talk about, and that's where you could create generational wealth as well for all 3 of them. Like my man Miles Monroe said, the value of life is not in its duration, but in its donation. You're not important because of how long you live, you're important because how effectively you live. You know, I think about, that's a phenomenal quote, by the way, and I think a very good friend of mine who passed away in August 2020. And this guy had a 7-figure business, a transportation company, where not only did he employ over 125 people, had a beautiful wife, children, and grandchildren that were all part of the business, but the people that he employed, he owned 180 different rental properties in 3 different states. And a lot of those people would be part of his rental properties. And he was always in the community. He was always given. His level of contribution was, if you look at what Tony Robbins says, he talks about the degree of your contribution is in direct proportion of your income. And this guy's income was incredible. His contribution and growth was incredible. And he lived between Florida and New York, and he lived life to the fullest. He would ride his bike 25 miles a day. The guy was in phenomenal shape. Sometime during the initial stages of COVID, he actually got cancer and he passed away. And we had a very phenomenal friendship. And when I think about him, you know, I think about how effective life insurance was for the continuation of his family business, not only from the real estate perspective, but also from the transportational company. And the death benefit that came to his family was there to serve the next generation because of all the proper planning he did. The point is, he died very young, lived life to its fullest, and really understand the value of contribution and growth. You know, as you learn about the different kind of life insurances, the question that you really need to ask yourself, if you were to pass away today, would you leave your family enough money to get by? And you know, my answer to that is, hopefully you're not leaving enough money just to get by, right? So when you understand the dynamic of life insurance from a standpoint of generational wealth and continuity of your business and your world, it's really understanding how to maximize your cash inflow versus outflow, position dollars properly, not only to buy the right kind of insurance, enjoy it while you're alive, but also make sure that your family just doesn't get by, that they financially succeed in ways that you never could have imagined. So remember, you always got to ask yourself over and over a question, is there enough? And then once you ask that question, not just meet your needs, but exceed your wants. And there's 3 kind of life insurances. Number 1 is term, number 2 is whole life, and number 3 is universal. And these serve different purposes based on what cycle of life you're in. Some are more out of pocket than others. And at the end of the day, if you position them properly, you'll always have more than enough life insurance to be able to create that generational wealth. And God forbid, if you did shuffle off this mortal coil, at least you won't have the fear of your family having to have no money after you leave. What is term insurance? It's a type of life insurance that guarantees payment of a stated death benefit if the covered person dies during a specific term. So what does that mean? Let's say if you're 20 years old and you buy a 30-year term policy and you happen to pass away when you're 52 years old, well, it's not going to cover the death benefit because it's past the 30-year term. However, if you pass away when you're 49 years old, it will cover the death benefit. So there's a lot of risk in term insurance as you begin to get older. And remember, approximately 99% of term policies do not get cashed in because the insurance companies are so smart, they make sure, even though it's inexpensive, that it becomes very expensive once you get past the term in order to keep that death benefit. So from that perspective, it's their biggest moneymaker. Now listen, I'm not like one size fits all, add water, instant offense for your oatmeal. There is value in term insurance because listen, if you're married or if you're starting your business and you got a baby on the way, or if you have a couple of children, and a whole life death benefit is going to give you a $100,000 death benefit, but a term death benefit is going to give you $1 million and the cost is a lot less, obviously go with the term insurance because you're in the working years, the wealth accumulation phase of your life. But understand that you want to be able to upgrade that term eventually and be able to convert it into whole life as your income begins to rise and as you really begin to understand the entrepreneurial side of how to utilize life insurance. And most importantly, once you have whole life insurance, the death benefit never expires. Hey guys, this, by the way, whole life insurance is my favorite kind of insurance, and there's some secrets that I'm going to share with you shortly, but let's really get into what the definition says according to Investopedia. Whole life insurance provides coverage for the life of the insured. In addition to paying a death benefit, whole life insurance also contains a savings component in which cash value may accumulate. And that's where you may hear people talk about you get not only a guarantee rate of return by state law and by contract on these policies, but it also grows and then it comes back tax-free up to basis to maintain that tax-free status you would borrow. But that's where the tax efficiency side of that cash value comes into play. Whole life, when you really begin to complement it in other investments in your world, whether it's real estate, whether it's a 401k, whether it's an after-tax brokerage account, what begins to happen as if it's part of the overall financial mosaic, it could protect you later on from a tax rate that is moving up and down based on whatever administration's in office. And if you could understand the goodies behind that, it really becomes a solid financial backbone in the overall world that could help you have leverage, liquidity, and control at all times, especially during economic winter, and you can utilize this money for alternative investments along the way. So listen, sometimes people like watch my videos and they go look up whole life and they're like, oh my God, it's the highest commission product that's out there. Oh my God, you know, it takes a long time to build your cash value. And by the way, if it's not constructed the right way, both of those are true. However, the way we do it at Epic, we want to make sure that we create a customized policy that is specific towards exactly what your goals and objectives are, both long-term and short-term, which basically means that we want to be able to overfund these policies so you have access to money, your death benefits there, but you have access to money that you could use for alternative investments. Here's one hack. A lot of people love real estate, right? Now, real estate to me, if you do it for the long term and have a plan and a team around you, is always going to be very effective. Meaning you get 4 different rates of return when you buy real estate. If I have $100,000 in a savings account and I take 50 as a down payment down for my real estate, I only have 50,000 left in my savings account. However, if I have a whole life policy that I've constructed where I've accelerated the cash value, and let's say there is 100,000 in there, and it's earning that guarantee 4 plus dividend, and now all of a sudden I want to borrow 50 for that real estate, well, that 100 is still going to earn the 4. The 50 is going to go be a down payment on the property. The property is going to get 4 different rates of return: cash flow, depreciation, appreciation, mortgage interest write-off, and now you have the rent to pay back your policy. And in that space, rinse and repeat, focus with the right team around you, massive acceleration goes your way. So listen, I just shared with you before kind of the differences between term and whole life, but here's a quick, panoramic view from up top. Term, usually lower premiums, that's true. Death benefit, yes. No cash value, and there's a term limit. It's going to expire at some point, right? Whole life, obviously the premiums are going to be higher. So this is where dilution, deletion, and distortion comes in, because somebody may say, yeah, this costs more. Well, the reality is you're just moving money from one side of the balance sheet to the other, right? So just understand that in your nervous system, because if you could get that and have a true long-term, non-instant gratification point of view, a lot of good things are going to happen. Yes, there's a death benefit. Yes, there's a cash value. You get that guarantee rate of interest, can borrow against this policy, and have uninterrupted interest. So you're going to use other people's money. You don't want to borrow it to go on a European vacation, of course. You want to borrow it because you're an entrepreneur, or because, listen, you have ideas about how to use your money in a multiplier fashion, just the way the bank would. And being able to do that and understand these little techniques is the difference between good and great. So this is our last kind of insurance. It's called universal life insurance. Quick definition: permanent term insurance, higher premiums for insurance that never goes away as long as you pay. And I'll get specific on that in a second. Very quickly, savings component if it's indexed universal. So very good complement to whole life. Part of the premiums go to the death benefit. Part of it is held by the company in an index. Think of the S&P 500 index. Cap is typically 9% with 0% minimums. And by the way, if this isn't presented properly to you, this could be very confusing, the 0% minimums, and it could also set you down a rabbit hole that you might not like 20 or 30 years later, which I'll get into in a second. So let's talk a little bit about the universal life policy. The index universal life, I'll keep it real simple for now. When you look at index universal, what happens is you get not only the cash value component that grows, but it's important to understand that in the early years, you want to overfund this because the cost of insurance in this policy, unlike a whole life, becomes more expensive as each year goes by. For example, if I put $10,000 a year into a universal policy in year one, maybe $9,000 goes towards cash value, $1,000 goes towards death benefit. 20 years later, that gets flipped. I'm putting in $10,000, $9,000 goes towards the cost of insurance, only $1,000 goes towards the death benefit. So if it's not properly funded, and if the stock market doesn't perform later on, because this is an index universal life policy, the cost of your insurance becomes more expensive. What we do in an overall general strategy is we want to make sure that we complement this with whole life and at the same time overfund this in the early years so we have protection in the later years. So quick recap on the index universal life, and it is a dice roll if in fact you're just paying what the baseline premium is in the early years and not overfunding it, because basically what you're taking the risk of is that you're expecting every single year the stock market to perform. There's years that the market doesn't perform. There's years it goes down. And in those years, if you didn't overfund it early on, and it could be later on in the policy, that cost can eat away at your cash value. And when you're in your 50s, 60s, or 70s, you could be writing checks much bigger than what your baseline premium is. So it's important to understand how to specifically customize these policies so they work for you and you don't have to work for them later on. All right, listen, I'm gonna just keep this real simple for you, but I want you to understand that nothing in life is in general terms. Everything is specific to who you are. But let me play with this a little bit. You have investments which have risks, right? Listen, the stock market's a risk, right? Whole life insurance has guarantees. And think of one thing. Banks have what they call Tier 1 capital. Tier 1 capital is money that the banks use to loan out to all the people that come to the bank over and over again. That Tier 1 capital is guaranteed, right? They don't put money into the S&P, they put money into Tier 1 life insurance or Tier 1 capital for life insurance. However, all you folks out here are very smart and you understand the importance of proper planning. I'm not a fiduciary, I don't diversify portfolios, but I want you to think of one thing when you look at the whole life and the guarantee. That death benefit in life, in your investment portfolio, gives you protection on how you manage your investment portfolio. So you never have to outlive your money, number one. But number two, when you retire, you could have a certain amount of money in these investments and spend them down differently, knowing that this guaranteed death benefit is going to replace whatever you spent. And in that space, you're staying ahead of taxes, you're staying ahead of inflation and fees, you're putting money back into your pocket where you belong, and at any given moment in time, because we don't know when we're going to die, you're creating generational wealth because of the proper planning that you did. So you just learned about the 3 different types of life insurance. And if you want something more specific to you, we do offer a free consultation. And if that's the case, go ahead and click that link below and one of the members will get back to you. So we just went over 3 different types of insurances, and I want to thank you so much for watching. You guys are really crushing it. You're educated. You're looking to take that next action step. Do me a favor, go ahead, because every single day we're dropping new content, new education. Hit that subscribe button, ring that bell. And oh, by the way, check out this video over here. Very informative information that can help you take that next step.